All right, good morning for Friday, April 5th. Got something real interesting for you today to show you. If you recall, I pointed out a trade that actually ended up losing money, but I want to show you where I got back into this market and just got out of the market about 15 minutes ago. That was the US dollar Canadian dollar trade. Now, if you remember, we've been looking at this for a few days now. The market obviously is in an uptrend, right? The market pulled back to a nice support level. Right? If you measure from this low down in here up to the high, the market, look at that, the 50% retracements right in here. Okay, and if you recall, we went long yesterday as the market took out this inside bars high. If you recall, we went long at 101.56 with the stop directly below the lowest low of those prior bars, right? The stop was at 101.21. We're risking 35 pips on the trade. And you can see this bar right here got us filled. Actually, we were filled as I was filming the video yesterday morning. The market intraday came down, knocked me out. So I lost 35 pips on that trade. Okay? Lost 35 pips, no big deal, right? Try to keep those losses as small as possible. And again, remember, this is a very significant level in here. We've got a 50% retracement. You know, the market is, back to that 50 exponential moving average right in here, right? Market is holding at 61.8%, right? Market came down. Now, if you take a look at yesterday's price bar, made a high up here, made a low, closed pretty much mid-range. Okay, open here, closed right here. So what I'm thinking is, okay, got stopped out, took a 35 pip loss. Now, where would be a logical level for me to re-enter this market? But first, the market's got to prove itself. The market has to prove itself and to go higher. I'm not going to just buy it in this range hoping that the market's going to bounce. Now, granted, yes, we're back to the 50 exponential moving average. We've started to penetrate down through it a little bit, but we're at the 50% retracement of this big up move here. As you know, if I'm looking to go long the market, I like to see penetration through highs to prove that the market wants to go higher, right? So what I did was, here, let me take off this red. Okay, so look, we've got an inside pattern, right? Lower high than the prior bar's high, and the low is higher than the prior bar's low. Took the trade as it took out the high and had my stop immediately below those lows. That's fine. The market came down and took me out. I lost 35 pips, right? Full transparency. I have losing trades as well as winning trades. But I want you to see here that you got to keep your losses as small as possible. So whenever I'm buying the market through the prior bar's high, my stop is always going to be below that same bar's low. Because if I get stopped out on the day of entry, I want to be out of there because the market reversed on an intraday basis like you see yesterday. The market took out the high here and then immediately reversed down through the lows. Boom, I kept that loss small. That's why I do that. So that's my general rule. When entering the market through the prior bar's high, looking for the market to move higher, of course, my stop is always going to be below the prior bar's low, because in order for you to get taken out, the market's got to create that engulfing pattern, the outside pattern, right? That's the opposite of an inside pattern, right? The inside pattern, the energy it's all getting coiled up. The market's contracting, right? The market's got to expand. The opposite of an inside is an outside. And so that's what happened yesterday. See, you've got this outside pattern where it did take out the prior bar's high here and it took out the prior bar's low, but it closed pretty much mid-range. So what I was thinking is, if the market can now penetrate up through the high of this, we'll call it the engulfing pattern, or OVB, outside vertical bar is typically what I refer to it as, okay? So the market's got to prove to me that it does in fact want to go higher, okay? So I went long as the market penetrated up through yesterday's high. Okay, yesterday's high was 101.65. I went long at 101. Let me write this down for you. 101.67. 101.67 was the buy. And again, that is right up through this high. Okay, that was the buy. Buy at. Now look at my initial stop loss was larger than the one I had on yesterday when I lost 35 pips. Okay, when I bought it up through the high, as the market penetrated up through yesterday's high, I went long at 101.67. Where do you think my stop loss is based on everything I just showed you? It's going to be directly below the low of that engulfing pattern, right? The ISL stands for initial stop loss, right? So my stop was 101.01 because this low was 101.03. So I went 2 pips below it, 101.01. So my risk in this, so let me write this out for you, 101.01. So R equals, risk equals 66 pips. Okay? So what I'm going to do with that risk is I'm going to look to make at least that risk. So I'm going to add 66. So let's go 101.67 is my entry, right? I'm going to add 66 pips to that. Okay? And that gives us what? 1.02. 102.33, right? If you add 66 pips up from 101.67, it gives you 102.33, okay? So that is profit objective number 1. And this particular trade takes 70% of the position off. 70% of the position off. And let the remaining 30% ride. Okay, so look at where the market went up to today. If you look at this market today, so write this down if you want, but look at today's high, 102.34 and an eighth, so almost 102.35. So that the market really popped. So again, just because you get stopped out of a trade, you shouldn't get discouraged. You know, you got to come back. If it's still looking right, if that market's still looking right, you need to look to get back into that market at a logical entry, right? So again, when the market is trading at logical support in an established trend, right? Again, you had the 50%, the 50 exponential, the 50% retracement. You know, again, I want confirmation that the market wants to move higher. So when I see these inside patterns, I look to go long above the high with an initial stop directly below the low. Got stopped out, lost 35 pips in here, okay? Looked at this again, said, God, look at, we got the opposite of an inside. We've got an outside. Took out the high, took out the low, closed pretty much mid-range. So I was saying, okay, if this market continues to drop, that's fine. I'm not looking to go long, right? I'm only looking to go long as it penetrates up through a high, because if the market's able to penetrate through the prior day's high in a logical pullback into support, okay, then I'd be willing to get back in, and that's exactly what happened. Went long again at 101.67. My stop was larger this time, almost twice as my entry yesterday. Okay, so you might ask, well, why didn't you take off 100% of the trade, be done with it, and call it a day? Because the name of the game is to try to make as much as you can when you've got a winner. This is a pretty big bar, right? This is a big bar. I mean, if you look back, I don't see a bar as large as this. So it'll be interesting to see where it closes. If it's able to close in the top quarter, that's going to give me more confirmation that's going to move higher. So, but I took 70% of the trade off at 102.33. So I not only got back what I lost here, but I'm up on the trade altogether. And now what I want to do is I want to trail that stop. I'm going to trail this stop up to below the 102.00, okay? 102 even. So I'm going to, okay, I don't know what happened. I thought I paused it for a second here. So 102.98. 102.98. 102.98 is the trailing stop on this. So 70% off at 102.33. Not bad. So still long this market. I'm about, what, 18, 19 pips below where it's currently trading. So hope that helps. Have a fantastic weekend, and I'll be back with you on Monday. Bye for now.